Hey guys, Tim Melvin coming to you from down here on Tuesday afternoon from Southwest Florida. Running way behind on virtually everything today. Had to spend the morning getting my every 3 year or so colonoscopy, which was almost, but not quite, as much fun as being a stock index or large cap growth stock investor in 2022. Guys, right now, don't fight the Fed has to be kind of the phrase of the day. I first heard that back in the 1980s from Marty Zweig on Louis Rukeyser's Wall Street Week, a show that all of us old dinosaurs remember and remember very well. We used to either rush home on Fridays to make sure that we saw the show when it aired at, I believe it was 8 o'clock, or we had someone set, the VCR in order to tape record it so we could watch that episode. All of the best fund managers and Wall Street luminaries went on Mr. Rukeyser's show on a regular basis, and it was mandatory watching. In fact, it was on that show that's why I actually called the crash the Friday night before it actually happened. He had a few simple rules, guys. Well, actually, there's 13 of them to be exact. I'm going to really narrow it down and focus on two today. First off is do not fight the Fed. Simply put, Mr. Zweig believed very strongly that if the Fed was lowering rates, bringing interest rates down, it's a great time to be a buyer of stocks. If the Fed was keeping rates steady, that was also a great time to be buying selected stocks and to be owning stocks that you had previously purchased. However, if the Fed was tightening, if they were raising rates to slow down the economy, to fight inflation, whatever the reason was, it was a terrible time to own stocks and be broadly invested in the stock market. As a rule of thumb, that one's held up better than most over my career. And here's where we are, guys. The Fed is going to raise rates. They're not going to slow down if the markets swoon. They're not going to slow down if the economy slows down. We may get a recession out of this. In fact, as I'll point out, the market's certainly telling you there's absolutely going to be a recession out of this sometime probably in 2023, where conditions get bad enough that we call it a recession. Fed's got a long way to go, guys. Inflation, if you look at personal consumer expenditures, the Fed's favorite measure was 6.45, which was down from the higher level of 6.7% the month before, but it's still really elevated. And if you were going by PPI and CPI, it's even higher. Remember something, guys. In order to feel like that you're getting the Fed, the inflation rate back towards the target of 2%, we're going to need to see rates positive, real rates. That's coupon minus inflation rate, positive all across the yield curve. Right now, the Fed funds rate has a negative yield of over 6%, possibly even higher, depending which measurement of inflation you use. There's a long way to go. Esther George of the the Cleveland Fed, said in an interview last week that, look, she thinks rates will be 4% by the end of the year, higher than that into 2023, and she doesn't see any rate cuts in 2023 at all, because inflation rates are going to have to stay higher to fight inflation. Why do I care what the lady in Cleveland thinks? Real simple, guys. She's on the open market committee that votes on this stuff. So is Neil Kashkari of the Minnesota Fed. And he told you before Powell's speech that rates needed to go up to a certain level and stay there for a long time until inflation was truly beaten. Guys, rates are going to go higher. Nobody knows how much higher. They're going to go higher, and they're going to stay there for a while. So it's going to be difficult to be an enthusiastic buyer of the broader markets and those, all story, no profits, growth stocks trading at 15 times sales, which shockingly, there's still a whole bunch of them out there. It's been rough for those stocks. It's going to get rougher, I believe. They have absolutely no choice. Inflation is much more dangerous than a recession. Powell showed his reserve in Jackson Hole a week ago last Friday. So we're just going to see how this plays out, guys. But now let's go on to rule number 2. And that's going to be don't fight the tape. And right now, the tape has a decidedly negative tone to it. Momentum started to break in the next to last week of August. And it certainly by the end of the month had completely broken, and we were into a free fall. Now, you're going to see snapback rally, guys, like the one that we saw that ended in Jackson Hole, but it lasted 6 weeks and, recovered a significant portion of the losses before heading back down again. The tape's overall tone is going to stay negative for an extended period of time with brief periods of positive momentum, in my opinion. We've been saying this for close to a year now, and we've been right about it, and we've been particularly aggressive about reminding you to avoid those no-story growth stocks. On that one, I will take a victory lap, guy. So I told you to stay away from them. If you ignored me and went with the stories and the hype, you have gotten creamed. You got to stay away from those. They're going lower, probably a lot lower in here. And it's probably not a great time to be a broader index investor, guys. If you look, the S&P 500 has a price to earnings multiple on a trailing basis of 19.83. It's historically very high. We're also very high on the forward forecast, trading the multiple of what analysts think the S&P will make. That is a dumb number. I call it the jackass number, but that number is probably going higher because in July and August, earnings estimates went down at twice the historical rate for how much rates went down in the third month of a quarter. That's kind of, the second month of a quarter, first and second month of a quarter. They're probably going to go lower still outside the S&P 500. I think the rate is probably even falling by faster than 5%, particularly in some technology communication stocks. Here's what we got. Higher interest rates, absolutely mean lower price to earnings ratios. Now, you're going to have a lower multiple of what could well be dramatically lower earnings. Keep in mind, guys, second quarter wasn't a disaster, but if you backed energy out, and earnings were still down 4%. So nothing to write home about, nothing to celebrate in there. And technology stocks, for the most part, got waxed. Not quite across the board, but not far off it either. So we've got some problems coming up. You're going to have falling earnings and falling price to earnings ratios. That could get us to that 3,000 to 3,100 level that I talked about. That's a lot lower than here. If either of those two factors accelerates, then we might bring Credit Suisse, I believe it was the bank that made the suggestion of 2,400 on the S&P. That could bring their numbers into play. That's really bad. But you know what? So is what we've done to the economy, guys. We've set up a situation that allows stagflation to be a very real possibility. We're going to have a recession, I believe. So do the bond markets. If you look at the 10 to 2 year inversion, the inversion is worse than any time since the internet bubble actually blew up and everybody was losing a ton of money, with thousands of jobs were being lost, and we fell into a rather nice little recession to start the century. It's more inverted now than it was at the end of 2007, going into 2008, as the great financial crisis accelerated. So, the bond market, it's always been the smart money market. I am not of the belief it suddenly got stupid. So I think, recession is almost inevitable sometime in 2023. Keep in mind, guys, we're not there. The jobs market is tremendous. Unemployment rate is still very low. Everybody pointed to the small creep up in unemployment rate last week. Guys, more people went back into the workforce. We've actually got more job openings than we've had all year right now. The employment market is in fantastic shape. So jobs aren't slow. Consumers still spending. Now, they are using credit cards and drawing down spending a little bit, but it's not panic levels yet. Credit card growth is up, and it's up sharply. But debt service ratios, household debt service ratios, they're still at the low end of the curve. The U.S. consumer, except for those on the very bottom of the rung, they're having some problems right now. Those that have decent credit and savings, they're still spending. Spending's not going up as fast as it was, but it's still going up. Until we see that change, we really shouldn't have a deep talk about how deep and awful the recession is going to be. We're going to have one. We'll see how bad it is. Right now, the consumer's got a lot of firepower left. It's when they get reluctant to spend it and start burying it in the backyard, that's when things go off the rail a little bit. Bonds are in an absolute free fall, guys, as I'm sure you can imagine. We saw some healthy, increases in yields today, and this is gonna create an opportunity for those of you who just want to park some money. Remember, forward returns on the stock market. Some of the models are showing negative returns. Vanguard, who tends to be a little bit more positive, says, maybe we get 3 to 5% over the next 10 years as an average compound return. It's not very much. Heightened chance of major declines. So if you're getting nearer to that time where you're going to be taking your money out, it may be time to getting some money out of stocks and into someplace where you can park it. And right now, I'm looking at the double B segment of the bond market. Double B rated bonds are the absolute sweet spot of the bond market. They're one level below investment grade. They yield more, total return is more, I should say, than triple B markets, as they should be. Lower rated should outperform higher rated. However, because of much better default rates, they actually provide better historical total returns than the single B bonds. So keeping an eye on this part of the market. Big fan of it. Just take a look at some of the bonds I found, just doing a quick search today to give you an idea of, for short-term parking, what type of opportunities might be out there. Kinder Morgan Energy, one of the largest energy infrastructure companies in the country, stock symbols KMI, they've got a bond issued 9/1/2023. Right now, the total expected return on that bond is right at 4%. That's a lot better than what could happen in the stock market over the next year. It's much worse too, but it's also much less risky. On September 1st of 2023, this company, which is, has this incredibly high probability of still being there, is going to give you all of your money back. That's very acceptable risk reward in here. Wells Fargo has a bond, and Wells Fargo, I don't care if you love Wells Fargo or hate Wells Fargo is not going anywhere. They'll be here when this bond comes due on August 15th, 2023, also a 4% yield. Energy Transfer, another one of my favorite MLPs, symbols ET. Tens of thousands of miles of oil and gas pipelines, terminals, gathering locations, and distribution systems. Just a fantastic company that gets energy from the production field to the market. 9/15/2023, so a year and a week, basically, 4.2%. Oracle, the big database company, they've got one also, 9/15/2023. It's going to pay you 4.14% over the next year. Longer term, and I'm not ready to jump in longer term because I do believe bonds are going to back up, but just to give you some idea of what's starting to develop out there, Xerox, August 15th, 2028. That's a little less than 6 years. Their bonds are yielding 8.49. You can love Xerox, hate them again. They'll probably never be a super exciting growth company again. They do have a lot of assets, a lot of in-place customer base. They have a massive customer base. And I don't think Icon's going to let anything terrible happen to them over the next 6 years or so. Brookfield Property. Brookfield's one of the largest asset managers in the world. They've got some bonds out there that are due April 1st, 2027. So not even 5 years, also an 8.425. Now, I'm not ready to jump in because I do think the economy is going to get worse. I think the stock market's going to get worse. I think bond markets will continue to back up. So these opportunities, we could get to the point where these higher quality double B and double B plus bonds are actually going to give us double-digit yields. That's going to get really exciting. That offers a very attractive alternative to what could be a very weak stock market. We'll see how that opportunity plays out. But right now, if you're overinvested in risk assets because you're at the age where the return of your money is more important than the return on your money, here's the way to get a better return on your money than you're going to get from Treasury or the banks. You have a very low probability of losing your money in these bonds over the next year, and you can collect some very attractive yields. I will say you'll need a decent bond broker to buy any of these. You'll need somebody that's got a pretty good relationship with the bond trading desks. Most of them aren't listed, and I'm not guaranteeing that you can buy them all at the same prices that they most recently traded on my screen today. But having a conversation with a guy who's a pretty good bond broker, I think Schwab has some folks available that can help you, is one name that comes to the top of my head. If you have a full service firm, your broker should be able to help you. So if you're looking for shorter term paper, that double B place part of the market looks very attractive to me. Wouldn't go any lower than that because then you're taking on more risk than I personally really think most of us in the distribution phase of life should take. So there's your opportunity. On the higher end, on the longer end, let's wait. I think we might, good chance we're going to get to double digits on some high quality companies that will survive the decade to pay us back our money. Now, looking at high yield credit spreads, guys, they were back over 5%. They had pulled back and we're getting down to the point where they're going to go under 4 again during this recent rally. Note back over 5, heading to the 6% level where we're starting to get really interested in buying stocks, and the 7% level where it's everybody in the pool, and we're going to be aggressive buyers of certain segments, particularly of the small cap, private equity replication, and small momentum stocks. That just becomes a massive buying opportunity. And frankly, we're looking forward to being in place to take advantage of it. We just have to kind of wait it out. It could get sloppy first. Guys, here's something I tell everybody. If you're going to do this and do this well and, make enough money to live the retirement of your dreams, to have the life that you want, if you are still in the accumulation phase of your life, you must learn to love the down. Okay? Fortunes are born in bad markets. If you had been an aggressive buyer of tech stocks in 2003, you have a lot of money today. If you were buying a lot of banks and REITs and beating up blue chips in 2009, you have a lot of money today. People that jumped in with both feet in the aftermath of 2000, when the pandemic hit, basically in 2020, made a lot of money in a relatively short period of time. Learn to love the down. It's where wealth is created. Yes, prices are probably going to continue to go down. The Fed, as I said, rates are going higher. The market's not going to like it. Probably going to see some downward pressure on stock prices. It could actually get quite ugly. Now, before I close up here, energy, we always got to talk about energy because I'm, a carbon energy bull. So latest news on the energy front, guys. Green energy is rising production in the United States. Not quite sure what percentage, but it's moving up. It's going to be the fastest growing source of electrical generation for years. It's not going to catch up to oil and gas for decades, but it's going to grow a lot faster than that segment does. We're nowhere clear to 100% renewable, and it seems we've done something ridiculously stupid. We do not have the high voltage transmission lines to get all of the solar and wind energy we're producing to the marketplace. We built the generation facilities in many areas of the country before we built the infrastructure. That is political stupidity at its finest. And look, I'm no fan of any politician or party, but this doesn't lay at the foot of one man. The electrical grid decisions have been made over a long time. Here's the truth of what's going on in electricity. And I'm going to include EVs in this. If we want to get to 100% renewable and 100% EVs, you have to expand the capacity of the electrical grid by 25 to 30%. And you have to replace a good portion of the existing. And you're not talking about 6 months, you're talking about years and hundreds of billions of dollars. And don't kid yourself. They'll tell you that the government and the electric utilities will pay for it, and they most certainly will with your money. They'll raise taxes and they will raise rates. So that's just part of the inflationary future brought to you by renewable energy. OPEC, by the way, yesterday, they cut production levels for the first time since 2020. They don't like where prices are. They want them higher. They're not shy about it. OPEC gets into squabbles when they're lowering prices, but when they're cutting production to raise prices, pretty much everybody's on board. And then one of the weak spots in energy has been China. Right, they're doing COVID lockdowns again as we speak. They are starting to lock down certain cities throughout China, and of course, their real estate market is an absolute disaster, and hanging over the economy. So there's been slowdowns. They haven't used as much gas as they expected to. What they have done is help their friends in Russia out quite a bit by buying rather large amounts of liquefied natural gas or LNG. They actually have in excess of the stuff. So Russia has cut off the Nord Stream pipeline for now. They're saying it's because they need maintenance and they need Siemens to fix some parts. Siemens like, hey, buddy, we'll fix the parts, but you really don't have to turn off the pipeline just for us to do that. We can do it while the pipeline's running. Putin's showing Europe what the future looks like if they continue to defy him. Natural gas prices in Europe are incredibly elevated. So China has out of the back door been selling the excess Russian LNG to the people Putin's trying to threaten the Europeans and pocketing the cash and adding to their hard currency reserves. You can accuse China of a lot of things, but not being smart, it's not on the list. So, anyway, Europe and the UK headed for an absolute crisis this winter, guys. If Putin continues to play this game and the worst case scenario plays out, we could see 60% shutdown of manufacturing capacity in the United Kingdom and something close to that on the continent in the European Union. It's going to be a mess. We can't get enough LNG to them quick enough to bail them out. Two choices: turn your coal plants back on or turn your nuke plants back on. Increasingly, the better option there looks like the nuke plants. Let's see if Europe figures that out and gets it done in time to head off a crisis. If the crisis develops, the play is going to be REITs in the United Kingdom and select banks in France. We've done a lot of research on that. All of this stuff is trading already at attractive multiples. It's not going away. The city of London is not going to fall off the face of the earth. It could get ugly, but you're going to see REITs trade at just prices that are just a fraction of the replacement value of that real estate. So you hate to see a crisis, but I try to never go into a crisis without an idea of what I'm going to do. I see one developing in Europe, so we're actively making lists of stuff that we think can survive a crisis and rebound, giving us multiples of many times our invested capital. So anyway, guys, I'm Tim Melvin. I've rambled on long enough today, but thanks for spending part of your afternoon with me. I'll be back next week unless something really shocking happens during the course of the week. Barring that, I will talk to you guys next week. Thanks again.